Mark, welcome to the show.
Thank you so much. Glad to be here.
Yeah. Mark, so you're my first financial planner I have on the show, and I'm really excited about that. It's something that financial education, for some reason, I don't know why it happens, but it tends to lag in our high school and junior high education. And what I found is that financial education tends to typically happen from in college or parents that are highly educated financially and they pass it on to their children. That's something that I experienced in my life, and uh, I feel like you could give the listeners a lot of advice on this type of financial education. And by the way, I love the Not Your Average Financial Podcast. I love that name.
Well, thank you. Yeah, I believe that average is in debt up to your eyeballs. All your money's trapped in your home equity drywall, and you maybe have a little 401k that you're slapping. Your hands are slapped anytime you try to get the money out. So
Yeah,
that's average. I don't want to be average. I want to be awesome if I can
yeah,
help it,
yeah,
right?
yeah. You're
And
right. Yeah, why
maybe
not?
like you, and maybe like most of our audience listening, I didn't grow up learning about money, and I certainly didn't have a focus on what would happen in the midst of a major worldwide multi-year pandemic and what to do in that, right? My parents didn't teach me that growing up for sure. So what does your money do when it goes through such gyrations we've seen in the last 20 years? I mean, we've had a
Yeah,
major market crash three different times just since the year 2000.
yeah,
And,
yeah,
that sweeps into it real estate, it sweeps into it bonds, certainly the stock market. Crypto has dropped 60%, some of it last year. So, where's the right place to keep our capital and cash so that we can do what we want it to do for us and we can live an abundant life, not just one living out of fear of the next person sneezing on my money and losing half my life savings. That doesn't seem
yeah,
like
yeah,
sanity to me. It seems insane, but that's the way the world has been running since you and I were in diapers, I
yeah,
guess,
yeah.
right or wrong.
I feel like if you don't get this financial education, every cycle wipes you out and you have to start all over. But it
Yeah.
doesn't seem to happen to a certain percentage of financially educated people. And I lived that myself in the 2008 market, a financial crash. I just got into real estate at the age of 25. I was super excited. I started making my money. I had a 3-year run. I got into the market 3 years before the 2008, and I had a great run. And then reality hit, and I was 25 year old, no financial education. I thought that world was going to continue, and the reality hit. And my financial education started after 2008. I said, this will never happen to me again. What happened? What is it that I did not see? And it so happens that all the financial educated people knew this was happening, knew it was going to happen. Even though the big banks, a lot of them, just were pushing these credits. But a lot of colleagues of mine that I had a lot of respect for that were financially educated, they gave the warnings. They exited before all this happened. So, where are we now is very interesting. It's very tricky. What's your take on the 2022 outlook and towards 2023? I know it's a tough question. It's a crystal ball you're gonna have to pull out now. But
Yeah.
give me your insight or what advice you're giving your clients for financial planning in these crazy, crazy market.
Well, my crystal ball, unfortunately, is on a shipping container, off the port of LA, and so I don't have it right now. No, I'm just kidding. No, without knowing the future, who is it? Niels Bohr said, prediction is very difficult, especially when it involves the future. So, given all that, what can we say is true? Well, I don't think volatility is done. We just went through a major market gyration in 2020. We saw a wild swing to the up in 21. The one of the pet who's it Tudor Jones just said that all of the inflation hedges that worked in 21 will be a failure in 22. That would include equities and crypto. Do I ha- it, do I know what will happen? No, I don't. But I can say that, like you said, sometimes the best horse in the race last year will break its leg this year, and we've got to continually ask ourselves what has stood the test of time, and what is it we want our money doing for us. I think if I was to give a hopeful, optimistic view of the future in the midst of that kind of volatility and turbulence, um, I would say the best hope I see is that people are starting to say, enough's enough. I'm tired of putting all of my money in the hands of some other guy or gal who may not have my best interest at heart. And they're saying to themselves, I'm ready to try it myself. I'm ready to take on this money thing, to not be scared of it, and to become my own money guru. I think a lot of people have given away their power and have given away their authority over their own money to some guy or gal behind a desk. And that could be an investment advisor, or it could be a commercial lender. And they've given away their authority and their power on money, and they're slaves. All right. They're slaves to somebody else's whims. Either you're in control of your money, or somebody else will be in control of your money.
So what would be your first advice to someone that decides to take control of their money? And I know it's a very broad question. I 100% agree with you. And that same thought that you just explained is what happened to me in 2000. I'm like, that's it. I need to figure this out, learn, and start investing back in myself.
Tell me what happened. What was that like for you? What happened in 2008?
It's your real estate's booming. Everyone's making money. It's easy to make money in real estate. I was a real estate appraiser, also flipping houses. And as soon as that news started blasting out, everything halted. Zero. No request for appraisals, nobody selling a property. Everything just went still, stagnant, and it was just a standstill for a while. And then the standstill turned into a decline. So, you're trying to scramble, you're trying to figure out where you're going to do your money, what you're going to do with your career, and not being prepared for that type of situation. For me, it was more of that, not being prepared for that type of scenario, even though it's a historical scenario. But when you look back, these scenarios have happened multiple times.
Sure. Well, and thank you for sharing that. And you're not alone. Myself and millions of others, hundreds of millions of others, went through terrible seasons like that in 2008. And 2000 was the chapter before, with pets.com and Enron and all that. If you remember the tech bubble, before that, savings and loans crisis. And before that, so the Iran Contra deal and all the stuff that was going on with hyperinflation in the late 70s and early 80s. The point is, the world will always throw us multiple curveballs that surprise us. And so I'd say the first best step any of us can take is to really get clear on what we want our money doing for us. What we want our money doing for us. I think too often we're just sort of handed a bag of rocks when it comes to our finances. Like, here's your 401k because you got your first adult job. Okay, fine. Throw that little rock in my backpack, right? Then somebody told you how cool Roth IRAs are. So you throw a little Roth IRA in your backpack. Then you get your little brokerage account. Then you get a little crypto because your buddy is doing it. Then you get that rental property. And before you know it, you just got this big old bag of rocks on your back. And you're like, why do I have this? Yeah, exactly. Yeah. And none of it seems to be helping you. It's all holding you down. All right. And we never really sat and thought when my wife and I, she got her first full-time job, she got that 401k. They just sort of laid a binder down in front of her and told her to sign here. But did we ever really think about what that was doing for us? Case in point, most people, when I sit down and talk with them over Zoom or over the phone, we have meetings all across the country and we have one-on-one financial consultations with folks. It's usually a very wonderful, eye-opening experience. I feel like it's some of the best conversations you can have in life involve money. Why? It's not because money's so cool, but money allows you to explore and experience this grand venture called life. And, when I'm having these conversations with people over the phone or Zoom, I'm asking them questions about their 401k, and they're sort of surprised when they learn that 401ks are all going to get taxed in the future. And I'll say to them, do you believe, Mr. Client or Ms. Client, do you believe that taxes will be lower or higher in the future? And Abiel, they all say taxes will be higher in the future. And then I'll say, well, what's your understanding of how a 401k is taxed in retirement? And they'll think, well, I don't really know. Isn't it a tax savings? Isn't it tax deferred? And I'll say, you're right, it is. It's tax deferred. Now, what does the word defer mean? And they think about it for just a second. And they say, well, it means put off into the future. And then they realize it. They see it. I can see it on their face sometimes. And they're like, oh no, I've created a giant ticking tax time bomb where all of that money in that 401k is going to be exposed to taxes in the future when tax rates are likely going to be higher. And for most people, that's the moment they say, who taught me to do this? When was I told that this was the right way to go? And it honestly, it's just been sort of handed to you, right? We all just sort of it's always been told the best thing you can do is get a 401k. It's a surprise to a lot of people when they realize the 401k was created in 1980, which means it's so young, it's not even old enough to retire yet.
And no, by the time they figure that out, they're getting taxed.
That's right. That's
later.
Right. Yeah, exactly.
Yeah.
So some of the best conversations you can have with yourself or with your spouse or with a buddy or a partner is to say, what are the attributes? What are the characteristics that you want your money to have? If you could wave a magic wand and just be Pope of money for the day and could create a brand new financial vehicle, I'd be curious about your answers to this, Abiel. Just spitballing here with you, little creative thought exercise. Sure. Like, just, we're going to be the, Pope of money, and you can wave your magic wand and create a brand new financial vehicle. And it can have any characteristic you want it to have. What sort of things would you want your money doing for you if it could just, be the unicorn?
Definitely something that creates monthly residual cash flow.
Yep. Cash flow.
Something that protects from high tax rate, where I could deduct taxes. Where I could grow value with time by holding whichever platform or item that is, and with time, I could create equity, and at some point, easy to sell, or if I need to exit in an emergency, that I won't be penalized that high.
Liquid basically. Access without penalties. Correct. Good.
Yeah,
cool.
That pretty much covers it.
Love it. Man, I think there's some things out there that might fit that characteristic, huh? But the reason why I start with function is we get so caught up in labels, okay? My bias, your bias, all of us have a bias when we start seeing things that look and sound and smell like that other thing over there, annuities, real estate, savings accounts, life insurance, hedge funds, all of those words instantly create an emotional reaction in most of us because of some experience we may have had or some radio host we may have used to listen to, So I like to start with that conversation because it gets to the heart of what you want your money doing for you. And that's a simple thought exercise. Any person could pull their car over and just take 5 minutes to start writing down some of the things you just said. Right. I would add a few of those just to my own list. When I was thinking about this myself, you brought up capital appreciation, you brought up tax advantages, you brought up liquid access without penalty, cash flow. Those are great. I would add to that maybe protection against lawsuits, okay, and protection against market volatility. So I want capital preservation, not just growth, but I don't want to lose what I earned last year too. I want it to be tax-free when I get the money out. I want it to continuously compound every single year. Again, I'm making this like perfect financial vehicle. So let's just grow that money at a competitive rate. Even if I'm grabbing the money out, I want it to continue to grow as if I am not touching that money. I want to be able to leave it to any person I want without the government getting its hands in it. We could keep going here. The list goes on and on. But
that's definitely a nice list.
Yeah. So how can we do this? And is this legal? Well, in my experience, in my searching for my own story, I came out of school with about 6 figures of student loan debt, and I needed a way to pay off all that debt. And I also wanted to do it in such a way that didn't destroy my ability to retire someday. Because I sit down with folks and we're going through their account statements, or we're going through their financial situation. And a lot of times they'll ask me a question like this. They'll say, Mark, do I pay off all this debt, or do I save and invest? Do I get into real estate now, or do I wait till I'm debt free? I hear that a lot, and maybe you do too. But the the answer I've come to now is do both. You can become your own source of financing and be the banker. That's better than being just debt-free. I used to think debt-free was the best pathway, but now I know that you can become your own source of financing and fire your banker. And now you're actually being the bank that you were cursing previously, So for myself, it was a best case scenario, because instead of paying off my debt, as the banker for myself, I bought back my debt from my creditors, Sallie Mae and the other student loan companies. I bought it back from them. And I've used that now to accelerate my wealth creation. And then again, I've started to continually use my source of financing for myself to invest in real estate and my business, my family needs, whatever it might be. So it's a mindset shift.
Yeah. So how did you create your own bank? Define that for me. It's I just want the listeners to understand that process.
That is it's sort of a mind-boggling statement, isn't it? Yeah. So it's not like the banks you know about down the street. It's not an FDIC insured bank. To get a true FDIC insured bank, you need about $100 million and about 10 or 15 years to get a bank charter.
Correct.
So I'm not saying everyone should go out and try that. But of all the things in the financial universe, I was searching as I got my CFP, Certified Financial Planner designation. I was looking at everything. I counted about 400 plus financial products, vehicles, strategies that you could put your money in. That'd be, real estate, annuities, mutual funds, ETFs, crypto, the list goes on, right? And each one of those 400 plus can be combined together. So I could combine real estate with, equities, and that's a REIT, a real estate investment trust, just for sake of example. So that's now hundreds of thousands, maybe millions of ways we can all put our money to work, which is why I think many of us just get overwhelmed and we just kind of bury our heads in the sand and think, well, it's too complex. I can't figure this stuff out. So for me, when I created my own list of like what I want my money doing for me, and it was very similar to the list you brought up, plus some of the ones that I brought up, I thought to myself, all right, is there anywhere in the financial world that does what I want my money to do for me without it being overly complex? And of all things in the financial universe, strange as it sounds, a modernized form of dividend-paying whole life insurance fulfills all the things that you and I just talked about. Mind-blowing to say it that way, but let me break it down before your listeners unsubscribe. And then I'll talk about how it fits in with real estate. Okay.
Yeah, got it.
And how I use it for real estate. So whole life insurance is 200 plus years of guaranteed growth. It grows guaranteed every single year. It has for hundreds of years in this country and beyond. And it just builds on itself on a guaranteed basis. You're going to have more this year than last year. It's not just life insurance. There's a living benefit, not just a death benefit. There's a pile of money, or they call it a cash value, that you're able to access with no penalty, like you said, no penalty, anytime you need it. So it's accessible. And if we've designed it correctly, there's no taxes due when you access that money. So, I just helped a guy earlier this week. He grabbed $800,000 out of his policy, the cash value, and he put it to work in real estate investing. Now that's pretty cool. Did he have to beg a bank for that? No. What did he have to do? He, submitted one sheet of paper with his signature at the bottom. And the two questions on that sheet of paper were, how much money do you want us to give you? And what bank account do you want us to put it in?
Yeah. How big was his policy?
Yeah. Well, he had a little over 800,000 in cash value.
Wow.
So he's able to grab as much cash value as you have. You're able to borrow about 90% of it. Now that borrow word spooks some people, so I'll explain that next. You can borrow against the cash value of your life insurance, like a bank, okay? And unlike a bank, you don't have to get approved by the lender. There's no credit check. There's not even a required repayment plan. You're able to repay that loan if you wish, but if you never repay the loan, it would just be deducted from the death benefit years later when you pass away.
What is the rate on something like that?
Well, give you an example. This guy, he plans to take the money out. He's putting it into syndications, LP, passive income, that sort of thing. So he's going to get the money back in about 4 years when they refi. Okay. And the APR, the annual percentage rate to borrow that money, was 1.9%.
Oh, Jesus God. Seriously?
Yeah. Yeah. Why is that? Well, some insurance companies charge more than that.
Oh, yeah.
You know, but the companies that we choose charge a simple interest rate all year long. And I don't want to get too technical. I know it's a podcast and we're not looking at calculators right now, but in his case, in most cases, if it's a 4-year loan, it's about a 1 to 2% APR, which is phenomenal. But it's actually a bit better than that, and quite a bit better. And let me explain. So when he borrowed his money out, the policy is called non-direct recognition. The loan itself, it's a specific kind of loan called non-direct recognition. The insurance company essentially does not recognize that you took that loan. So when you borrow against the life insurance policy, it continues to grow as if you hadn't touched the money on the entire $800,000.
Wow.
Or whatever your particular cash value is. Yeah, it is. Yeah, it is.
I've never heard that before in my life.
It sounds too good to be true, to be honest, when you first hear it.
It really does.
But let's stop and just think, is there anywhere else in the financial universe that lets you borrow against it and it keeps growing? Well, have you ever heard of a HELOC?
Yes.
Home equity. I'm sure you have. Yeah. Any kind of line of credit. Your home does not care if you have a mortgage on it or not, right? You can borrow against your house, the HELOC or a regular mortgage, and the Zillow doesn't care that you borrowed against your house. It's still growing. The house is still growing, even on the capital you borrowed against your house, right?
Correct.
And now that's just like a whole life policy that has a non-direct loan, but there's one difference. Houses are not guaranteed to grow, right? You can go underwater on a HELOC, and they can freeze your line of credit, and they can force you to pay it off, and they can term it out, and the house can go underwater. With life insurance, it's guaranteed to grow, so you'll never be underwater with life insurance loans.
So life insurance has never declined, even when the markets crash.
Correct. Yeah, it's not tied to the stock market, so it's actuarially, it's guaranteed by the insurance company to give you more cash value this year than you had last year. And they can't take away the right to borrow against the policy. So there's no banker in between you and your money. So in this way, it's somewhat safer than, say, even a HELOC or a line of credit.
Got it. That's pretty incredible. First time I ever hear this. Very interesting. So this is how you created your own loan.
Yeah.
You created yourself as your own bank.
Our story, and I'll keep it brief, was we used it for a couple of things that we needed to do. We bought a car with it. Why would we pay cash for a car? When you pay cash for a car, you lose all that growth, right?
Yeah,
so
correct.
Borrow against it. And why would we use somebody else's bank? So we used our policy to buy a car. We went on a month-long trip to Hawaii. And I'm not recommending everybody do this.
You still got to enjoy life. You still got to have some fun.
Well, if we were going to go on vacation anyway, the power of this is while we were on the sands of Hawaii, we got a letter in the mail showing us the growth of our policy. And it was the same growth we would have had otherwise had we not gone on the vacation. So that was like a no-guilt trip. Yeah. But the real purpose of why we started it was not for the cars and the vacations. It was to help us pay off all that stinking student loan debt.
Yeah.
And then now we use it for real estate investing, and we use it for other investments and business acquisition and, marketing campaigns. And when our daughter's ready for college, we'll send her to college using the policies. Why would we use somebody else's bank? Why would we even pay cash? Because remember, when you pay cash for something, you're actually financing it from your future. When you pay cash, you stop growing that money forever. And that's a way of financing.
Yeah. Exactly right. Now, what percentage of your personal portfolio are you invested in real estate? And I want the listeners to know specifically which type of real estate are you invested in?
Well, it's probably about 40 to 50%. And we do a lot of syndication deals and we use our policies to put that money to work in syndication deals. Awesome. I was telling you before we hit record, I'm really a lazy real estate investor. Mm-hmm. One, because my focus and my passion is this business. I love it. We work with a number of advisors and train the advisors, and I have colleagues that work across the country So our focus, my attention is money and helping people understand this world of money. I don't know what you know about real estate. And so I do know the power of real estate as a certified financial planner. Guys, listen to what Abiel is sharing with you, because it's real, and the tax advantages and the cash flow capacity. Any CFP that does not mention and on regular occasion recommend real estate, I think is doing their clients a disservice, because it's as old as the pyramids. Real estate is for building real wealth. So everyone definitely look into real estate.
What specific asset class are you? I know you mentioned to me you're in a couple commercial. So what type of commercial?
Oh yeah. My favorite one right now I can share is a mobile home park that we put some money into a syndication deal, and that one for me has been really interesting, because we've gone through a world where folks have been wanting to get into, like, they're looking at working class neighborhoods, and cash flows have been squeezed, on cap rates have been squeezed. But mobile home parks are one of those finite supply asset classes where they're not building a whole lot of new mobile home parks in the country. And a lot of mom and pops are selling those old mobile home parks with the broken street lights. And so the deal that we recently have been invested in got a ton of different mobile home parks. They've renovated them. They've laid the pavement. They've put in a pool and a playground, and they've started collecting reasonable rent and so forth. And it's just, the yield on those has just been phenomenal. And I love the ability to see those tax deducted every year as well.
Yeah. Some of my listeners are multifamily investors that they own their own assets, or they're raising capital, or they're trying to get into the business. How do you underwrite your deals? Not just the deal itself, but I would say, how do you identify the sponsor or syndicator that you feel comfortable? Same way like someone would try to figure out is Mark the person that's going to help me with this financial advice? Yeah. How do you do your research on the syndicators that you're looking to invest with as a limited partner, as what you call a lazy investor?
Yeah.
How do you do it?
As a lazy investor, how do I choose which syndications to participate in? Yeah. It's the same criteria I have for when I'm training a new financial planning associate that works in our firm. There's 3 criteria that I look for in any syndicator: humble, hungry, and smart. Humble, hungry, and smart. And I'll kind of break that down quickly.
I like that.
But humble, I want them to be willing to say that they've been wrong or that they got a bad deal. I don't need them to sugarcoat. And I'd be happy to go over some of the considerations and downsides of the whole life insurance that we just went over there, because there are some. Because I think anyone who looks at things only half full is missing something. So humble. Hungry, I want them out there working hard. I don't just want a syndicator or a sponsor to be, collecting checks and not doing any work. They need to be out there making the deals happen.
Grind.
Yeah, man, it is. It's nothing passive about it, right? And then finally, smart. And that I put that into 2 categories. Smart is, for me, like intelligent and critical thinking skills, willing to really analyze a deal, but also smart in that they're not doing stupid things that could land them in jail. They've got high integrity, in other words. So that's what I mean by humble, hungry, and smart.
Yeah, I think that to add to the word smart, I think it's very important. Communication. Communication between a syndicator and an LP. I found that a lot of syndicators assume that they don't need to explain everything in detail. Some LPs don't care for it, but there's some that they do want detail. And communication is a key factor between that relationship. And I agree with you. There's mistakes are going to be made in every project. You're naive to think that in a multifamily project you're not going to be making mistakes. There's not going to be some loss of money here and there. The overall outcome at the end should be successful. But there's mistakes that are made along the way, and not being honest and not disclosing these things. So I do see what you mean with the concept of being humble. So I do agree with those terms. And I'm also taking notes for myself. Yeah.
Well, and I'd say it fits my world too. I think the the CFP world can sound like a kind of like an otherworldly alien class of people, like some sort of priest and lay people, whatever. Like I just want to just dispel that myth right now. And I think the best financial planners will help you realize that you are your best money guru, like I mentioned earlier, where you can help us know. We'll certainly help you find the hidden risks in your portfolio. Like I was just on a call with a guy. He's been incredibly successful in real estate. He's about to get a $10 million buyout from his business partners. And he's going to go, live in the mountains and just enjoy the next couple of chapters of life. But he and I were talking about.
He'll be back.
Yeah, that's right. Yeah. Well, I'm like, what are you going to do next? And he's like, I'm probably going to do some more deals. So you're never out of the game, right?
No.
But the power there is just, learning to think and listen carefully. I think the best thing that you can do, Abiel, and I can do as a certified financial planner is to say, all right, what is this person across the table from me really wanting here?
Correct.
And listening so well that you can understand what they said and what they're not saying, but they want to be saying. I think the best conversations in life are those ones that you're like laying out on the field of grass and you're with your buddy and you're looking up at the stars and you're thinking about what the future holds. I feel like financial planning conversations could be like that if financial planners got out of our own way and stopped talking about how our rate of return was on our portfolio last quarter. That's important, and we get to that, but it's in service of the heart and the goals that the person across the table wants to accomplish.
I think personality has a lot to do with the way people invest. Finding that right instrument as an investment vehicle, it's hard to find. Like, your world is very complex for me, and it's so many moving parts. Like, you have my mind spinning about that insurance loan, and I don't have life insurance. I've always been it doesn't motivate me. But now that you just created a motivation. I'm like, hold on, I could get a loan off my life insurance. Now you just triggered something that I didn't know existed. Investing on paper wasn't motivating for me. I always felt like I needed to hold the real estate. I need to see it. I need to grab it. I need to touch it. And that's how I found my happiness investing. And having been attracted to your industry, but you just dropped some knowledge on me. Now I'm like, I could get a loan on my life insurance like that. That's amazing. So now you open my eyes to something else that I'm definitely going to want to consider. Anything that I hear close to a 1 point something interest rate on a loan, that's unheard of. So that's a good financial education you just gave us. Mark, hedge against inflation. What are you doing for this?
Well, let me quickly say thank you for saying all that. And once again, I'll just quickly mention while we wrap up the life insurance, we can certainly spend more time talking about it, but be aware of people that you talk to. There are 400,000 life insurance agents in the United States. 400,000. That means one for every 800 Americans. And if there were 400,000 heart surgeons in the country, would you just pick any of them? Probably not, right? If it was your heart, my heart, So very carefully look for people who have expertise here. Case in point, the loan interest that you mentioned. There are several really big life insurance companies that charge 8% on your money and penalize you by reducing your dividends on the cash value when you borrow against the policy. That can wreck the growth, and if you needlessly borrow from the policy, you can make the policy lapse just because it was designed incorrectly or not managed well. So be very, I guess, the shortcut here, the thing to remember is look for a bank on yourself professional. That is the credential or the phrase that I would suggest folks look for. Bank on yourself professionals have gone through rigorous training to make that like their specialty, their expertise. It took me about 3 years to really become proficient in the bank on yourself strategy and get that credential. So look for bank on yourself professionals. They'll make sure that you get the right companies, that it was designed right. So to your question about inflation, Abiel, any comments on that before I rush off to your question you asked me a while back?
No, that's basically it. I just some advice on inflation right now. It's at 7%. I think the last time I checked. Correct me if I'm wrong.
Yeah, you're right.
And I know there's a lot of strategies. We're investing into multifamilies for inflation, But in your world, what would you suggest?
Well, you had Rod Khleif on a while back too.
Yeah.
He was talking about how, and you mentioned it in a recent podcast, solo cast that you did, talking about how cash flowing real estate is a great way to hedge against inflation. It is, as long as rents are allowed to be collected by our government. And that's a big asterisk right now for a lot of us right now in many markets. But I would say, combine two assets together. There's peanut butter and jelly. They can go really well together. There's Batman and Robin. They go really well together. There's nitro and glycerin. They go really well together. Kaboom, right? Dynamite. If you just have one asset, real estate, cash flow real estate, it does some things really well. Cash flow, tax advantages. It's harder to get access to money if my money's tied up in a deal, right? We have to admit that. And, the hedge against inflation is there, but there's some counterparty risk with, if the government gets between you and your renters, it's going to be tricky to get that money and rent collected. So what can we do to take the power of the nitro, but add some glycerin? If we use a whole life policy designed the way we've been talking about here, whole life insurance is tied not directly to interest rates, but it's sensitive at least to interest rates. So if inflation does 7% again this year, or 15% this year, is anybody here saying that it can't go to 15%? It has before, right?
Yeah.
In 1980 and 1981, 82 was 15, 18. Whole life insurance in those years. Yeah. And most of the time, whole life insurance grows at a nice conservative middle single digit return. Nothing special, but it's predictable and it's guaranteed, middle single digits. But in those years, in those 1981, 82, dividends on whole life insurance were in the double digits. They were keeping up with inflation. And it's liquid and accessible money. So unlike real estate where you have to beg a banker, and by the way, there's a great quote by Mark Twain. He says, it's a great quote. He says, Abiel, a banker is a fellow who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain. Great quote, right? So in the world where we can't get money out of our real estate piggy banks, having a giant pool of contingency cash in the cash value of the life insurance policy makes you more resilient in the face of crisis. But even better, it makes you take advantage of opportunities. It makes you more competitive. Like when all the other sponsors and syndicators can't get access to money, and you've got 6 or even 7 or even 8 figures of money, cash value sitting in your policies that you can tap for any purpose, and there's deals to be made, right? What kind of deals could you pick up in the midst of the next crisis, whatever it might be?
Strategy. I like that. I'm gonna have to speak to you about that after the podcast. Sure. Mark, you've been very educational. It's been a great time. I just want to have one last question. What's your take on? I would say it's the number one question my friends and family ask me. Should I buy a single family now?
To live in or to rent out?
To live in and rent out.
Okay. Yeah. Well, to live in. Should I
be buying a single family property in this market?
Man, what I want to hear can you answer that question? Because I could probably speak out of both opinions here. What are your thoughts?
My first question to them is, do you see yourself living in that property in the next 2 to 3 years?
Mm-hmm.
And even past 5 years, do you see yourself living in that property? And you'd be surprised when I tell them 5, they're like, I don't know about 5 years. That's usually, then I'll start going into it deeper there. And okay, so if you're not going to be there in the next 5 years, what if you buy at this peak price? How are you going to sell that property?
Right.
In 5 years? Do you think the market's going to stay this way? They pretty much answer their question when you start asking them that reverse. What's your take on that?
It's a great answer. Yeah. Well, I'll say if it's for the purpose of shelter, there's nothing wrong with getting the house that you're going to stick in for a long time. I think our grandparents bought one house, right? And now we buy 5 houses over our lifetime on average, as the average American, 5 houses. And
is that the statistics now?
Yeah.
See, I didn't know that one.
Yeah. Over our lifetime. Crazy. 5 different houses, and we keep a mortgage on it. And we, the average American in 1940, 11 cents on the dollar went to servicing debt, 11 cents. Now, according to the U.S. Commerce Bureau, 37 cents of our dollars go to debt.
Wow, it's incredible.
So if time is money, what's 37% of your day? Right? Do you really want to buy at the peak price where you've got, and everyone says, well, Mark, my interest rate is so low right now. Interest rates on mortgages are so low, I can buy a big house. Well, why do you think we can buy a big house? Why are prices so high? Part of the reason why prices are so high is because interest rates are unnaturally low. And if interest rates are about to go up, and I don't know what the future holds, I really don't. If interest rates do go up, what happens to house prices? No one can buy that McMansion anymore when we've got a 10% mortgage or whatever, or even a 5% mortgage. And so home prices all come down when that happens. And do you want to be stuck holding that bag if you're going to move next year or 2 years from now? So I love your idea about 5 years at least, longer even.
Yeah, that's it. I'm surprised that it's true. I look back at my lifestyle, and I mean, I'm in real estate, so I probably move more than the regular person does. But looking back, definitely bought way more than 5 properties. And I'm looking at my friends and family. Yeah, they've moved around. My parents been in the same house 30 years. Yeah, it's a whole different generation.
Sure.
Our generation is career driven. We're moving along. We're mobile. We could work from home. We could work from anywhere. I agree with that.
And there's no judgment. It's just a matter of like, what do you want your money doing for you? You got to have that conversation with yourself, with your spouse. And if money is tied up in the drywall of one's house, that's, in many ways, that's a zero interest savings account, with no guarantee. There's downsides. You got to just ask that question before you pile in.
Mark, it's been a pleasure, man. Thank you for all this financial education. I'm definitely going to get in contact with you about that insurance policy on life insurance. I'm really have my mind spinning on that. Mark, where can listeners get in touch with you?
Well, you mentioned the podcast at the beginning, so I'll mention it here at the end. If folks are looking for some financial clarity without the market madness, if they want some access to capital for their deals or for their real estate projects, you can meet me. You can go to notyouravagefinancialpodcast.com. That's notyouravagefinancialpodcast.com. Click on the button there. It says request a meeting. And we'll just have a 15-minute quick call and say hello.
And I'll drop the link too. Mark, thank you for your time. It's been a pleasure.
My pleasure. Thank you.